When the guys running the printing presses are the biggest buyers, this isn't speculation anymore. I've been saying this forever. These are the central banks. It's a signal. And when the smartest institutional money here in the United States flips from sellers, we've been net exporters, to buyers, we are net importers, you better be paying attention. A reset is coming. Bottom line, do not trust the government data to guide your moves in precious metals. Their incentive is to mislead, not protect you. I've been saying that forever. Misdirection. The people here, the institutional money, are taking in billions and billions and billions and billions of dollars a month worth of gold and silver. They go from seller to buyer. If you're not paying attention, you're going to miss one of the greatest wealth transfers of all time.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for September 15th through September 22nd, 2025, while supplies last. This week, 1 10th-ounce gold maple leaves are just $37.50 over melt per coin. 1 ounce assorted silver bars are just $1.65 over spot per ounce. We also have near historic low premiums on pre-1933 gold. Call us for details. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always delighted to have this returning guest. It's a privilege for me to introduce you to you again, as we do each week for our weekly market update. Andy Schectman, the CEO of Miles Franklin Precious Metals. Today is Tuesday, September 16th, 2025. Andy, thank you for coming back on Liberty and Finance for this weekly market update.
Good to be here with you, brother. Thanks for having me.
There is so much going on in so many different arenas right now, it's hard to know where to start. One thing I wanted to touch on first, because everyone has been watching this, is the remarkable progress northward for silver and especially, and also for gold, or should I say, the remarkable evidence of the dollar's decay. Could you talk to us about what you're watching? And you've been talking to us about this for quite some time. You're saying this really looks like it's the time, about the strength in the metals markets relative to the dollar in particular.
Yeah, there's no question that something bigger is happening. I mean, there is no question about that, right? And a lot of it focuses on the LBMA. I'm going to try and make this part a little bit easier to understand. It's somewhat complicated for people who don't understand the lingo. I'll try to make it as easy as possible. First of all, when you look at gold, speculators are returning into the gold market. We can see that on COMEX with open interest rising again. That means open interest is the amount of interest, and people are interested in buying the metal. Open interest is rising, and prices are breaking out of this consolidation range. We see it bust out again. That's the normal link between purchasing and higher prices, right? But in silver, what we're seeing is something different. The rally is being driven not by speculators, but what seems to me by some form of a short squeeze. Because you have record high lease rates in London to lease the gold. That would be the same thing if you wanted to short a stock. There's a cost to borrow the stock from an entity that then allows you to short it. A stock is something, if you short something or naked short something you don't have, you have to borrow the stock first and then short it. Same thing here. You have record high lease rates with silver in London, anywhere between 5 and 6.5%. Normally, those lease rates are somewhere around 1% or a fraction of a percent. Even in times of stress, they barely get above 1%. Right now, they're between 5.5% and 6%. I'll talk more about that in a minute. But you also have falling open interest, meaning the demand by the speculators is falling with heavy delivery demand. So far, 58 million ounces have been delivered since late August. Almost 11,000 tons have been delivered year to date. This points to shrinking physical liquidity and mounting pressure on the market. In other words, the short positions are struggling to get the metal to cover their positions. As the lease rates go higher, the people who own it are like, nah, we're not going to give it away 5 or 6%, which is way higher than it ever is. with everyone standing for delivery, this is a problem. And when we talk about what's happening on the LBMA, recent data shows about 600 million ounces of silver are traded every day in London. There's about between 1 and 2 billion ounces of paper claims on meaning they could stand for delivery, between 1 and 2 billion ounces, yet the official available free float is only 140 million ounces. So, in other words, if there's 1 to 2 billion ounces of claims against 140 million ounces available to be delivered, and a lot of that is already locked up and not truly liquid, what could possibly go wrong? In other words, London has virtually no free silver to meet these rising investor demands or to back the billions of ounces in outstanding contracts. This is getting interesting. And at the same time, you see the COMEX flush with metal. All of that metal, I remember I screaming, this is not about tariffs. And all of that metal that's come back to the United States has put I believe the U.S. banks on solid footing. Normally when the U.S. bank shorts COMEX, they go long delivery contract in London to offset. Well, they've brought all that metal back, and you could argue to put their book in order. These European banks are facing an existential threat. With lease rates and prices spiking, the risk of a delivery default in London is rising. And, this is the chain reaction that you would talk about. Silver, its status as a Giffen good. I don't know if you know what a Giffen good is. Then again, a Giffen good is something that as prices rise, demand increases. Most assets or investables are the opposite of that. As the price spikes, demand falls. With this, as price rises, demand increases, making shortages even worse. As the industrials will say, man, the price is rising, we got to buy more, we got to get it, we got to secure it. The hedge funds and the traders say the price is rising, let's jump on, let's get them on board on this. And its status as a Giffen good makes the potential shortfall even worse. Now, when we talk about silver, as far as I'm concerned, it's up 43% this year. And when you have a Fed that is going to come in and lower rates, into an environment where asset prices are at or near all-time highs in the stock market, in gold, when silver's on this run, I would expect to see this rocket fuel charged. When the market was from 2007 to 2011, when they cut rates, gold went up 118%. From 2020 to 21, when they cut rates, gold went up 35%. So I think not only will you see that in silver, you will see it certainly in gold. But going back to silver for a moment, 52 million ounces of silver were already delivered on COMEX this month, with 3 weeks left to go to push it even higher, just over 2 weeks. And as I mentioned, those lease rates at as high as 6.4%, they never get above 1 to 2%. And if only briefly when they do in times of stress. This is signaling that the bullion banks are trapped by their own over-leveraged promissory notes, the European bullion banks in particular. I think that's something that needs to be focused on. At the same time, you have silver added to the strategic minerals list by the U.S. government. This means that big buyers are entering the market, including the U.S. government. Companies like Tesla and others will stockpile silver at the same time. And so London's deliverable silver supply is vanishing. Its industrial needs and its investor demands are colliding between the industrials like Tesla and the investors. This is Giffen's good at work. I don't know. I'm looking for a severe shortage. Not to mention, you have a 45-year cup and handle pattern on silver, which is one of the most powerful technical setups you can find in markets, period. And on such a long time frame, it carries huge implications. It portrays 45 years of suppressed energy ready to be released, kind of like a coiled spring. And I think that the structural and monetary pressure, once unleashed, the move is violent. The way that it typically works is that a cup and handle is a continuation pattern. The cup is the long base. In silver's case, from the early 1980s through the decades of the consolidation. The handle is the pullback, the tightening range, like 2011. So once prices break above the rim, that $50 price that we saw in 1980 and 2011, the price can go parabolic. The classic charting rules, the upside target, you take the depth of the cup added to the breakout point. So the depth of the cup, the rim is at 50, the bottom is just below $4 in the 1990s. That's about a $46 or $47 spread between the top and the bottom. So in theory, the breakout above 50 with no resistance above it, add $46, $47, the difference from the top to the bottom of the cup, you're at a $100 initial target, between $90 and $100. And when you throw in the shortage, when you throw in the demand by the big money, when you throw in the demand by the BRICS countries, etc., I don't know, triple-digit silver isn't really so out of control. It's not out of line as far as I'm concerned. One last point I'd like to make about gold and silver. You know, it's interesting to me that, and in particular gold, because silver has yet to catch the same fire that silver has, that gold has caught. And, you know, we look back over the last half a year or so, and the S&P 500 in the last 5 months or so is up almost 1,700 points. That's one of the strongest rallies in history, right? Gold is up about almost 40%, about 39%. When compared to the S&P's return over the last 5 months, which is one of the strongest returns ever. Gold is up since 2023. Gold's up 100%. The S&P is 67%. That's great. But just over the last 6 months, where everyone's focusing on NVIDIA and stuff, where it's up as big as it is, 1,650 points, gold's run is up 4 times the S&P's return just in the last 6 months. It's up 37% versus 9%. And so even amongst this AI boom, the biggest tech story since the internet, equities are still trailing gold, and yet nobody talks about it. So I remember when gold finally broke through $400. I couldn't believe it. It finally broke through $400 all those years ago. And if you would have told me that we are sitting at futures almost at $3,700 right now, and the media and no one understands it, to me, it's absolutely insanity. The big money understands it. And this is what I was talking about recently, where you have the largest exposure to stocks in the history of the stock market by mom-pa investor. You have the largest ever margin exposure, which is $1 trillion, and you have the largest exposure to options. So you have the public all in on stocks, all in on margin, and all in on speculation with options. At the same time, the investor, the big money, the insiders are leaving at a 7-to-1 clip, leaving the equity market and going where? I don't know. Maybe they're going to gold, as the biggest money in the United States is standing for billions and billions and billions and billions and billions, and I can keep on going every single month. Every single month, we are seeing huge deliveries into COMEX. And why does nobody talk about it? So let's just paint the backdrop for a minute and talk about our wonderful mainstream media that lacks all journalistic integrity, period. The greatest boom ever in the S&P because of the AI revolution is trailing the price of gold and silver. The insiders are dumping equities and running to, we don't know, as the public is all in the stock market, not just all in, greater than at any time in history. In fact, not only are they in greater than any time in history, the valuation is at the highest point in history, greater than the 1929 crash, greater than the '08 crash, greater than the dot-com crash. And they're not just all in, they're all in on leverage and margin. And so with all of this metal coming into COMEX, both gold and silver, record amounts, net importers, record amounts, and the public not owning any, and it outperforming the S&P, where the hell is Fox News? Where the hell is this idiot Jim Cramer? Where the hell are all the people that are supposedly looking out for you and I? And I got more to go, but I know you want to chime in here, so please do.
I was just going to underscore one of the things you said about the stock market being at all-time high valuations, and that's, anybody would say, well, sure, it's because the dollar's been devalued. No, you're talking about internal metrics where you're combining, price to earnings ratios that are internal metrics, balance metrics having nothing to do with the effectively inflated dollar. We're talking about real overpricing, not just inflated pricing. Go ahead.
All right, so let's just keep going talking about gold for a minute. I found it interesting, in particular, that this guy, article from investing.com. I'm going to read it to you because Adam Lipinski again, and I don't know if you remember Glupinski. I talked a lot about him a year ago, and I'm going to read what I said about him a year ago after I read this. I want people to think big picture. This is coming from the head of the Polish National Bank, the central bank. This is from investing.com. Poland's central bank announces plans on Wednesday to increase its gold holdings to 30% of its reserve assets, aiming to strengthen the country's financial security. Glupinski says in these difficult times of global turmoil and the search for a new financial order, gold is the only safe investment for state reserves, NBP Governor Adam Glupinski said in an emailed statement. He is proposing a motion to the bank's management board about raising the reserve target for gold to 30% from their 22%. Now, remember, I said I was all over this in 2023, screaming about this. Let me read you what Adam Glupinski said in 2023. When asked why does the central bank gold gold? Because it retains its value even if someone cuts off the power to the supply of the global financial system, which is based upon electronic accounting records. Of course, we do not assume that this will happen, but as the saying goes, fortune favors the prepared, and a central bank must be prepared for the most adverse circumstances. This is why gold has a special place in our currency management process. So he's basically saying, think about everything digital. When someone cuts the power to the financial system that is all based on electric accounting records, this is why we own gold. And now he's increasing it to 30%. When you look at the most well-informed traders in the world, forget about the wealthiest, we know that. They're the most well-informed traders. They drop crumbs, they give you clues. And so when we see a head of a central bank saying we're going to increase our holdings to 30%, instead of buying more treasuries, one that is aligned with the West, because we're very concerned. And if the power gets cut off to the global financial system, well, this is why we own gold. One last point I think I should make and regarding gold, and then I'll take any questions and go whichever way you want. You know, to me, what's really interesting right now about what we're going to see tomorrow, and I'll put gold into this basket, is normally the Fed would lower rates into normally they lower rates into a weak economy. Now, I would argue that we're seeing a far weaker economy than people would agree, because many people would agree, because you know, we saw a $911 or $12,000 revision of jobless claims, 911,000, the largest downward revision on record, on top of 263,000 jobless claims just came out last week. This is the highest since October 2021. You add those 263 to the 911,000 largest downward revision on record, we're continuing to slide into a soft economy. But normally the Fed would cut rates when stocks are well below record highs. So you're cutting at a time when stocks are at all-time highs. Also, gold typically performs best when rates are low. So the fact that gold and silver have held up so well in what had been a rising rate environment, what happens when they acquiesce and give up and they cut? I would say that it's rocket fuel for the gold market. And this is a very interesting time. In essence, what this is going to do is it's going to benefit the upper 1%. It's not going to benefit the people. It's going to benefit the upper 1%. When they cut rates, asset prices go higher. So too does the cost of living. And the people with the assets, right now, you have a period of time where the top 10% of Americans now own 93% of all the wealth. The bottom 50% of households owe 2.5% of the wealth. So history says long-term asset owners will be rewarded as rate cuts begin. This also means that the rapidly growing wealth gap will only become larger, especially as core CPI inflation, CPI inflation is back above 3% with the economy weakening. This is, recession fears heading into meeting the printing press. This is stagflation. This is something where it's going to get very, very interesting and would only make holders of our assets want to flee capital, to leave, and to go after things like gold, which I believe is just getting going regardless of its high price right now. So happy to take any questions or go whichever way you want to go here.
Well, just two things to underscore what you've already talked about. Then I do have another topic after that. One thing you just talked about, cutting rates, how it benefits the asset owners, not those who have to have their cost of living is already stretched. They're already hurting very badly. The bottom half of the households in the country are already hurting to make ends meet. But a related topic to that is that during the cutting phase, by the time the Fed has gotten around in past recession cycles to cutting, the supposed reason that they're cutting is to stimulate activity. This is Keynesian economics, stimulate activity in the economy. We had Phil Lowe on last week talking about this crazy modern monetary notion that the Fed has to control the cost of money in order to stimulate the economy. But if you look at the long-term charts from the Fed themselves, if you go to the Fed, the Fed Reserve educational site, and you plot out the so-called money supply over all the last recessions, they have these recessions in gray vertical bands. The cutting during the cutting period, which sometimes goes on for a better part of a year or two, is recession. So it's not like cutting and then you immediately bounce out of it and prevent or avoid a recession. You cut all the way through the recession. So you don't get immediate medical help from that.
No, you don't. And I just want to one time just drill this into people's head. Everyone thinks that gold is too risky because, it's up at these levels, yet it keeps on going. And this is even as the central banks continue, and the big money continue to hoard it as a tier one asset. When the guys running the printing presses are the biggest buyers, this isn't speculation anymore. I've been saying this forever. These are the central banks. It's a signal. And when the smartest institutional money here in the United States flips from sellers, we've been net exporters, to buyers, we are net importers, you better be paying attention. A reset is coming. Bottom line, do not trust the government data to guide your moves in precious metals. Their incentive is to mislead, not protect you. I've been saying that forever. Misdirection, right? The government numbers, the CPI, the unemployment numbers, everything, it's all a lie. And you can see it. The biggest deal to me above all else is that the people here, the institutional money, are taking in billions and billions and billions and billions of dollars a month worth of gold and silver. They go from seller to buyer. If you're not paying attention, you're going to miss one of the greatest wealth transfers of all time. I believe that in my soul. I truly do. And, it's interesting too, as the comment that we always talk about that Doug Casey made famous, that gold is the only true asset that is not someone else's liability. Well, I'd like you people to understand that on the United States government balance sheet, gold is the only asset on the federal balance sheet that is not simultaneously a liability. In other words, gold is the only true asset that the U.S. owns free and clear, and they continue to buy it, and it's going to continue to go up. And the fact that they put silver on the critical metals list or the critical minerals list, you just got a floor underneath the price of silver. The governments, but the U.S. has now put a floor under gold and silver. The days of remembering it get beaten down to levels that you can't even remember, like in 2020 when it went from 20 to 12 like that. Those days are over, and I think either people get it or they're living with a recency bias that is going to have them miss this altogether.
I recently just had Ed Steer on. I'm going to pop up the chart that he was so good to share with us. Let me just bring it up here right now.
My favorite chart.
There's his number of days to cover, number of days of production. In other words, of all the mines in the world are cranking out silver. But look, silver, as he said, is nailed to the back side of this, the most shorted material on the planet here. 155 days approximately of world production it would take to cover the short position. He did say that is starting to happen. They're starting to cover their short. And as you had said right in the beginning of this talk, the price action on the silver market looks more indicative of short covering than it does of just regular naked buying. So it's quite the time, and this correlates to that as well.
Well, it's interesting. Bloomberg just came out with an article. Bloomberg confirms the London one-year implied silver lease rate blasted above 5%. Now, I'm highlighting this because number 2 on there was platinum. While on September 4th, the JBMAs, that's Japan Bullion Market Association, Bruce Ikemisu reported a London one-month lease rate rocketing to an extraordinary 6.4% over the past 2 decades. Silver lease rates have usually hovered well under 1%. The reason I say that is that Bruce came out about 2 or 3 weeks ago and said that they are trading 3 million ounces of platinum spot contracts, deliverable contracts every day in London. In other words, contracts that could be delivered. Yet he said loco, meaning location. Loco Zurich and local London, there's 0 platinum available. So when you talk about platinum being suppressed, silver being suppressed, these dum-dums, these Western banks are going to, I don't know, they're in big trouble. And part of me feels that the Trump administration understood this, and this is why all the metal has come back to the United States. In essence, maybe the first step is covering these short positions that the Western banks have before it gets transferred perhaps to the U.S. government through some form of exchange or swap by the Exchange Stabilization Fund. I don't know exactly what's going on because we don't know exactly who's brought it back. I do believe the U.S. government is behind it. But in essence, if you want to bring all this metal back and then create a short squeeze on the European banks, which is what Tom Luongo talks about, that Trump is out to get them because he believes that the European aristocrats are behind many of the problems in his administration. And that's his belief, and it's an interesting story. It wouldn't surprise me because the real strain and stress is in London, in platinum and in silver in particular. Not as quite as much in gold, but the vaults are stuffed here in the United States. A lot of the metal has left, but a lot of it's still in the COMEX vaults in the ecosystem, which makes me feel that there's more U.S. government involvement than we are being led to believe. But in any case, all I can tell you is that things are getting crazy with gold, with silver, with platinum. And I think it's just beginning. And that's the part that most people probably have a hard time understanding because they've rallied so much, at least people paying attention. People in this country are completely and totally asleep, however, as it pertains to the investable public.
Yeah, I want to underscore the last thing you said about people saying, oh, gold's at an all-time high, therefore I wouldn't touch it. This is so ironic, and it is with absolutely the complicity of the mainstream financial press that people don't realize what they're saying. They don't realize that what they're talking about is the dollar is at an all-time low relative to gold and going lower. Oh, I wouldn't touch gold. It's like, oh my gosh, do you realize? I have had 2 clients tell me in the past week they have been just flabbergasted trying to talk to very intelligent, well-connected friends and custodians of money for organizations, saying to these people, do you understand that when the price of something is going up and up and up and the thing itself is not changing, that means the value of the dollar is going down. And yet people, when they see the price of gold going up, they don't think it's the price of the dollar going down, so they want to jump on the dollar. It's like jumping on the Titanic as it's sinking. It's like, look, there she goes. I'm jumping in. I'm in. It's like, this is the complete inversion of logic and rational thinking. If you have any comments on that before I go to the next topic, please feel free.
No. I mean, that's just human emotion and fear and emotion leading your decision making, the worst possible combination you can have in investing.
And like, say, a major medical phenomenon where fear was manufactured very effectively over the past 4 years with 7x24 coverage in absolute concert, curated message, pounding the public. Here we have, as you point out, no description by the mainstream financial press saying, gee, looks like gold and silver are a safe haven here in times of turmoil and volatility, and they're outperforming the stock markets and the bond markets and the currency itself.
I mean, that's a story in and of itself, Dunagun, for any real journalist, but then to highlight the amount of inflows into the COMEX, the fact it's not being talked about, and the shortages in London, and the amount of central bank buying, the fact that it isn't being covered should be Another crumb, another clue. All of these institutions, every single TV station, radio station, newspaper, magazine, they're all owned by 4 companies. The information is filtered down. Don't say anything, they would say. We don't want to be crowded out of our positioning. It's so contrarian to me. It's such an obvious contrarian indicator. You have to see the clues and try to have the courage to connect the dots. That's the scary part, right? You can see all the dots. Are you connecting them and being led astray or not? I choose to connect the dots and see what I think is happening. And it seems to me quite logical that this is something that's just beginning, and it's a change, a monetary change. And with the implementation of the Stablecoin Genius Act, which is far from genius, diabolical maybe, we've entered a new monetary ecosystem, and gold and silver will have, gold in particular, will have a more significant role than it has in the last almost 100 years.
Right. And now I want to focus on a major theme that you've been addressing over the past 10 minutes or so, and that's these stockpiled warehouses. So the COMEX warehouse, and I'm about to get to some more, but you also contrasted that with the depletion of physical platinum, for example, in London and where else?
Zurich.
Now,
which would be the main refining hubs.
In contrast to that, you have, so this is like the year of the warehouses, because you've got the Shanghai Gold Exchange, SGE, establishing this worldwide network of new warehouses and you can rattle off the countries faster than I can, but it's not just in Shanghai, but in the Middle East and in around Southeast Asia. They're talking about even in the Western Hemisphere, certain locations. So there's going to be this worldwide network of Shanghai Gold Exchange warehouse, physical gold warehouses all around the country, and then big
all around the world.
All around the world, excuse me, that's what I meant. And the big bombshell, Mario Aneko, our good friend and associate, just interviewed King Kong from Hong Kong on this last night, talking about the new domino that's falling. And Jim Rickards has talked for years about how difficult it will be to replace the U.S. Treasury and the U.S. dollar because of the deep and liquid bond market that all the countries need to use for their interbank repo lending loans and all this as collateral. And you've got King Kong saying, notice that there was a big spike in February and a big spike in the middle of the summer here of activity of physical, taking off or making sure that physical is in the Shanghai Gold Exchange, and warrants for it apparently being posted as collateral for overnight repo loans between non-U.S. banks. So as the U.S. beats its chest saying, King dollar, you need our treasuries, otherwise your banking system can't survive. The rest of the world apparently we're absolutely marching away from this and turning to use physical gold certificates from the SG warrants against physical gold in the Shanghai Gold Exchange for overnight repo collateral. Your thoughts on what this signifies if it's as it appears to be?
Well, it would be massive. It follows. It would add another layer to the things that we've been saying. So I've been talking about the expansion of the Shanghai Metals Exchange. Vince Lancy's been talking about that eloquently, whereby they're building vaults in multi-jurisdictional areas, starting with Hong Kong, which is finished, where you can take possession already of gold in Hong Kong through the exchange of the digital yuan.
Yeah, I've got to interrupt there. One really cool thing about Hong Kong, everyone, it was pointed out by Mario and by King Kong as well, was that there's no capital limits. I received a card in the mail from Capital One a while ago. I showed it to the viewers saying Capital One is going to be clamping down and limiting how much you can move around through withdrawals or transfers of that sort of thing. It's for your protection. And so these capital controls, but Hong Kong is free from that. Otherwise, people on the mainland of China, for example, have to apply for government approval before they can move large sums of money. Go ahead.
Right. So in essence, you have all of these vaults. The one in Hong Kong right now, you can take digital yuan and immediately convert it into gold and take it away. You don't have to convert to dollars first. And their aspirations then are to build a series of multi-jurisdictional vaults. The next one is under construction right now in Saudi Arabia. That is very significant because remember, Saudi Arabia was partners in Enbridge. They were the fifth partner, which is the cross-border settlement system. So it's significant in many ways, symbolically as well, that the second vault is being built in Saudi Arabia. The theory would be Saudi Arabia could sell its oil to China for the digital yuan. The digital yuan could then be just like that, converted into gold in one of these vaults, whether it be in Hong Kong where you take it or leave it there safely stored, or in Saudi Arabia, or in any of the other multi-jurisdictional vaults that will be built from parts of Russia, from all throughout the Belt Road Initiative, all over the place. They're going to do that, and they will connect with the vaults that were just built in St. Petersburg, in Moscow, in Singapore, in Dubai. They'll all connect. It is the ability to settle things outside of the dollar, to settle in gold, any imbalances, or all of it if you want. They're all going to connect. Now, what the repo, adding a repo layer on top of that is genius, actually, because what a repo is where I need liquidity and I have U.S. Treasuries and you're the bank. I'm going to give my treasuries to you. You're going to give me funding and I agree to buy those back from you at a premium at some point, but I need the money in order to take care of things today and tomorrow. So if you're able to do that and use gold instead of U.S. Treasuries, which is one of the reasons you're seeing all of these countries sell U.S. Treasuries to stockpile gold. This is why guys like Vince Lancy says 85% of the gold that the central banks are buying is not reported to the IMF. Why would you? Remember, we saw Saudi Arabia getting caught reporting gold, or not reporting gold last year, and China, but they got caught by the import-export numbers. But in essence, you have gold, which is outperforming the Treasury handily. It's doubled it over the last 25 years. It killed it last year by almost 10 times. It's killing it again this year. So when you talk about gold outperforming the Treasury but having no counterparty risk, it's almost a better vehicle than the Treasury if you have the rails of a Enbridge type platform that allows instant settlement in 7 seconds without the SWIFT interference at a 98% reduction in fees, where you can trade local currencies to do business with other BRICS countries and settle imbalances in gold through a multi-jurisdictional chain of vaults. Take that gold if you want, or let it store. And if you need a loan, in renminbi because you're going to trade with China and do whatever you want, and using gold as collateral, not only are you sidestepping the dollar, you're destroying the value of the U.S. Treasury. It is silent genius as far as I'm concerned.
Let's walk that path down a little farther by alleviating the necessity of international holders to hold treasuries to do this liquidity collateral. By able to use SGE warrants instead. Now they don't need these treasuries anymore. Treasuries come home. That causes horrible treasury auctions, which means there's no buyers, so the yields have to go up on treasuries. Talk to us about the implications of that. What's the knock-on effects if that happens?
Yeah, and by the way, a warrant, for people who don't really know, a warrant is basically just a delivery ticket. Give me my metal. Here's my warrant. And that's the point of lowering interest rates. The Fed says we're going to lower rates. Trump wants lower rates, but they're really only able to really affect the front end of the curve, the overnight lending rate. Now, they've been talking about the hidden third mandate of the Fed that really is never talked about, where they could, if they wanted to, start to affect the back end of the yield curve. I'll get to that in a moment. But in essence, if the 10-year Treasury is what we're focusing on here, if these countries don't want to hold our 10-year Treasury, they sell it. The price of the bond goes down. Prices of bonds and the interest rates are inverse of each other. In other words, if everyone is selling and the bonds are falling in value because no one's buying them, interest rates have to go higher and higher and higher to attract more buyers. Conversely, if everyone's buying the treasuries like they used to, everyone's buying and buying, the demand is so high, rates go down because the demand is so darn high for these treasuries that, rates are going to start to fall. They move inverse of each other. So if everyone is now usurping the treasury market, not only not buying them and actually selling them like we've seen, then the bond prices fall and the back end of the treasury curve rises. We've seen this recently in the UK, where they've lowered rates on the front end. That's all they're really able to do, the overnight lending rate. They've lowered them like 7 times, yet the back end of the bond market, the 30-year bond that they have is at or near all-time highs. In other words, the bond market says, you think you're going to lower rates right now. I mean, look at it this way. Right now, core CPI inflation, Dunagun, is at 3.1%. That's a lie. We know it's a lie. John Williams of Shadow Stats would tell us it's add an 8 to that. It's 11%. But let's just play by their numbers right now. They tell us it's 3.1%, right? So it's 110 basis points above their long-term target, right? And so when you talk about Trump wanting to see the yield go down as low as 2%, right? 2%, they want to lower it by 200 basis points. They'd like to see that come down. At what point do the institutional traders say, oh, so let me get this straight. You want me to buy a bond that is actually paying a real negative return, lower than the real stated rate of inflation, the CPI. Forget about the make-believe where we know it's much higher than that, but the number that you're actually quoting at 3.1%, the 10-year is at 4. You want to see the 10-year as close to 2 as possible. So you want me to lend you money for 10 years at a 2% return when inflation, by your own BS calculation, is at 3.1%. I'm getting a negative real return of 1.1% per year compounding. No, thank you. And that will just accelerate the rush into gold. And ultimately what happens is that all of the intentions of the Fed to lower the back end of the bond market, they can't control it because by lowering the front end, it betrays their ultimate goal is for lower in rates and higher inflation. It doesn't work that way. If you're going to have high inflation, then you need to have higher rates above the stated rate of inflation to attract buyers of your treasury. So in essence, what one would expect, and we saw this last year. Remember, they lowered the front end by 100 basis points or 1%. What did the 10-year do? Went straight up commensurate. The bond market is an animal of its own and sees right through the fact that the Fed is cornered and trapped. Add on to this a repo market substitute that is pegged to gold, in essence, using gold as collateral. It's genius. And the rails that they are building, not only the M-Bridge rail, which they've already connected, the 11 Asian countries and the 5 Middle Eastern, just the 11 countries alone in Southeast Asia have double the population of the United States and already are China's #1 largest trading partner. 800 million people are trading. And then you add into it BRICS Pay, which people don't talk about enough. BRICS Pay is the B2B side. It's the retail side. They are now introducing it to the Belt Road Initiative. 75% of human population. They're rolling it out to everyone else except the US, the Euro, European Union, and the UK. Same thing with BRICS Bridge. So the BRICS Bridge, the M-Bridge, that's central bank to central bank. BRICS Pay is retail. You're covering all of your bases, which is chipping away rapidly at the transactional status of the US dollar. And then the reserve status is getting beaten over the head by things like this, which will only accelerate the demand for gold in lieu of the US Treasury. In essence, if you don't see that things are massively changing, if you are stuck in this dollar-based, recency-biased, make-believe fairy tale where it always used to be, you add on to the fact that no one trusts us anymore, and we're going around the world sanctioning punitively tariffs, threatens, wars. We're at that point. The history books will talk about this point right now as, especially with the Genius Act implemented, as the beginning of something new. Don't know how it looks when it finishes, but I would say we are at that point right now where the table has been flipped almost completely over, and things are going to start to change.
I know we've got a wrap. Thank you for going on this long with us, Andy. I appreciate that, to giving us extra time. If we could quick hit the weekly specials before we wrap so everyone knows what you've got available this week on special. Not to mention that premiums are still pretty special on most things, but
stupid if you ask me.
So what have we got to offer that we want to make sure everybody's aware of?
Right now, the specials are 1/10 ounce gold maple leafs at $37.50 over melt per coin. Melt is the same thing as spot, right? A melt of a 1 ounce coin would be spot. Spot is calculated by 1 ounce. So when we say over melt, it's spot divided by 10 because it's a 1/10 ounce coin. So we could say over spot divided by 10 over melt. Anyways, $37.50 over melt. The 1 ounce silver Engelhard prospector. I normally don't, dig in too much to these specials to explain. Those are $2.99 over spot. What I will tell you is that the Engelhard prospector, Engelhard is no longer in business creating rounds. When most of my career, they were the preeminent name in bars. They were the most respected, high quality name brand bar. The 1 ounce prospector coin is the most sought after 1 ounce round in the industry, period. They don't make them anymore. I have seen them for part of my career higher than Silver Eagles. They are very much sought after. It's an unusual silver round. It's unusual for me to say that. Most silver rounds don't have that kind of demand. These do. They're amazingly cool at $2.99 over. And the last thing is 1 ounce silver, assorted silver bars, dealer's choice, $1.65 over spot. So again, premiums are very low on everything. You could argue that the 1 ounce random bars are a better value, but I would tell you that the Engelhard prospectors I would rather own just because they are as rare as hen's teeth. And I have seen for many, 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 many years, the demand for those are very high in the secondary market.
That's one of the things that I talk about with clients on a daily basis, and that it's not what you prefer, it's what the next person's going to trust. So whoever your potential future trading partner is, and we've certainly, from a reluctant prepper's preparedness standpoint, we've talked about doing the mental exercise of actually doing the thought experiment and projecting yourself forward into scenarios in the future. If we're entering an atmosphere of reduced trust, and I think that's undeniable, then you really need to put yourself in the shoes of the potential trading partners. You want the greatest possible pool of trading partners, and having the thing that people are going to recognize and trust is going to be super important. That typically leads us to the U.S. Mint. So the U.S. Mint is going to be something you don't want to neglect there. But once you've got that layer covered of the U.S. Mint, that would be both junk silver and Silver Eagles and Gold Eagles, then adding on additional weight, you want to still do that in a way that's going to be the most recognized, trusted, and liquid.
Yeah, being penny wise and pound foolish is something we see too often in this industry. Liquidity is incredibly important, and people need to work backwards and say, if the you-know-what hits the fan for me personally, and I need that money, I want something that instantly is liquid. But remember, as well, and I don't want to paint the picture as too many do, and I don't want to be guilty of piling on it, and that gold and silver are not just for the you-know-what hitting the fan, they're also for opportunities. And where we are heading, we may see lots of opportunities. Rick Rule always talks about having dry cash, dry powder. One last thing before I let you go, I just think it's humorous. You know how we've talked about Rick's comment for years about the 1/2 of 1%? And his standard verbatim line was the allocation in gold and gold-related equities from Joe and Jane Sixpack to the Harvard Endowment Fund is 1/2 of 1%. What just happened last month? The Harvard Endowment Fund spent over $100 million on gold. So I think it's very interesting that maybe they've been listening to Rick for a while and decided to jump in and buy some metals. So you're beginning to see this become a little bit more mainstream. We're not there yet, but just wait until the public catches on. And these amazing premiums that we see now and have been talking about for over a year, like that will disappear. That I do believe, because the dealers who the primary distributors who are choking on product, at the same time, you're seeing the biggest money in the world by billions and billions and billions and billions every single week and month. these big distributors have not been incentivized to go out and buy more. So very quickly, things can shift. All it takes is one event to wake people up, and then there's this big gap between availability and supply where premiums go much higher. I don't know, other than the price being very high, which is enough to throw people off the scent, the premiums in relation to it are the lowest I've ever seen. Still, it's an unusual time, incredibly unusual, but that only benefits those who see things maybe a little bit more clearly than the public does, and there's still lots of opportunities all over the place in this industry.
Well, Andy, we're always grateful for your presence here. And folks, if you don't want to miss a single episode with Andy or a single weekly market update with him, make sure you're on our free mailing list, because sometimes this moves around depending on our schedules. You don't want to miss that. So make sure you're on our mailing list. It's free and it's private. You just go to libertyandfinance.com, all spelled out, libertyandfinance.com. Put in your email address, click submit, and make sure you confirm on the confirming email. You'll get one email in your inbox per day, including every interview with Andy, and all of Andy's weekly specials will be in there as well. You won't miss a thing. Andy, always thank you for joining us on Liberty and Finance.
Dunagun, you and yours are the best in the business. I wouldn't miss a week. I hope you have a wonderful rest of yours, and to everyone else out there, thanks again. Appreciate it. Look forward to picking up where we left off next week.
Very well. Thank you, Andy.
Bye-bye.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for September 15th through September 22nd, 2025, while supplies last. This week, 1 10th-ounce gold maple leaves are just $37.50 over melt per coin. 1 ounce assorted silver bars are just $1.65 over spot per ounce. We also have near historic low premiums on pre-1933 gold. Call us for details. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.